So after the significant level have been created, see, there is a significant level here, you can call this, and there is a significant level here also, right? So it went below this and then it went above this and it closed here, right? So in between this and this, there's a significant level, right? Okay.
Yeah, correct.
Right. And after that, it started breaking the high. So what comes to my mind is that, okay, it is trying to go up. Okay. But the problem is it is high volatile. So that is the reason you see that it came below this and then went high. Again, it is high volatile. Okay. So if we look at this, what is our next point? Point number 5 is what?
Creation of a level.
Formation of a significant levels, right? Do we need to consider option strikes here as well for you can, but options is not matured in this thing in commodities yet. So what you can do is, I don't know what is the volume coming right now. Let's see what is the volume coming. So what I'll do is let's look at options here. Okay, and let's take crude oil from here and let's see 17th of September is gone. Okay. So 17th of October. Okay, let's look at 17th of September. Okay, sure. Let's see what's coming in. Okay. So there's a call at 4100. Every 50 rupees there is a strike price, right? Okay. So kind of every 50 rupees there is a strike price. Okay. So let's see the way we do it in equities. All right. Now, say for example, let's get rid of all this. Say 22. Okay, on this particular day. All right. So let's see. There's a level at 4750, correct? All right. So nothing significant seems to be happening here. Let's look at 4800. Nothing that's significant. Let's look at 4850. So it went up, okay, but nothing that's significant. Let's look at 4900. Sorry. So it again broke out. Okay. 4950. Okay. So it broke out. Again broke out. Okay. Let's see. Let's look at 5000. Okay. Nothing much. $49.50. So it closed above and it closed below, right? So this seems to be a resistance, right? So this place seems to be a resistance at 49.50 because it went up clearly after opening below. See, it went up and then after opening above, it clearly came down. So this could be treated as a kind of a resistance. So from this level, it should break out, right? Now, let's see. So it went down and finally it went up. So this day was a breakout day, right? This particular day was a breakout day, all right? So if we look at it, when this broke out, this and this level were the most significant levels, right? So this place and this place, okay? So we can see here and we can see maybe somewhere here, okay? Because when it broke out, it broke this candle out completely, see, okay? So the low of this day and the high of this day are both significant, and this should be a full trading day, okay? Please remember. Never forget that all these, wherever you are trying to make decisions, should be full trading days. There shouldn't be any half day kinds, okay? So, so it is happening, okay? So at the bottom and at the top. So you can see from here also there's a bounce, here also there's a bounce today, okay? So, all right, fine. Now, okay. So the only thing is that when we are using this, we got only one trade, maybe, or two trades, okay, in the entire month. But that should be enough because there would be around 100 rupees, 50 rupees kind of a trade, okay. And please remember, if you are trading, say, around one lot, which is 100, okay, you will always keep a target of 50 rupees in crude oil. Okay, so if you're trading in one lot, okay, you will trade with a 50 rupee target minimum. All right, so 50 rupees should be the right target, and for you, the stop loss would be 20 rupees. Okay, so it is more or less the similar kind of this thing. So what will happen is that if you gain, you will gain about 5,000 rupees in one this thing, okay, or 500 rupees in a mini contract, okay. And when you will lose about 200 rupees in a uh, mini contract and 2,000 rupees in a mega contract, okay. And please remember, uh, bracket orders doesn't work in commodities, okay. If you're using zero, the bracket order will not work. If you want, you can use a cover order. But with cover order, the problem is that you cannot put a target. Okay? Bracket order will not work with commodities. Okay? It is not SEBI approved. So only cover order is available. Clear? Okay. Now, in your trading plans, okay. Uh, so generally what happens is, say if it is 5,000 rupees or so, okay. In the commodities, it takes about 600 rupees to buy one, what do you call, this thing in a cover order. Okay, so if you have say around 500 rupees in your account, you can buy one. One means one quantity. Okay, so so you'll have to do a correlation with the risk to reward ratio. Okay, and from that perspective, it is a lot cheaper to what you call trade in commodities. Okay, but it is a lot more expensive if your stop loss is hit. So please remember that the risk level is more in case of commodities, but uh, what you will find is when you will practically start working in this market, that your exposure in commodities market is lesser than equities market. Clear? Okay. And practically what you have to do is keep a 100 rupee target per month for one commodity. Okay. So what you'll have to do is that trade only one commodity at a time. Okay. So if you are say allocating say 20,000 rupees for commodities, okay, uh, say in mini contracts you can work. There's no problem. Okay, and with cover orders very easily you can work. There's no problem at all. Okay, it's a very cheap market to work in. Now, what you should do is per instrument you should be defining per month target. Okay, and the best or the right kind of target in case of say crude oil is 100 rupee target per month. There are 4 weeks, which means there would be 4 inventories. Okay, so finding out 2 trades is not difficult. And once you are matured, if you are trading in say uh, 10 lots, okay, say for example you are trading in 10 lots. 10 lots is nothing but 1,000 quantity. So 1,000 quantity into 100 rupees, okay, is 1 lakh rupees. So it's not a small amount. Okay, so please keep a target. Okay, that roughly say 100 rupees a month in trading crude. Okay. Now, more or less, this thing works the similar way. Whatever you have in this. Okay. The only problem is that if we look at say options, one the reporting is not that great in options. Okay, so let's look at the put call. Where is it? Okay, so it looks more or less similar to the NSC data. Okay, and you can look at it. So, say for example, for the October month, okay, say 5100 strike price. Okay, this side is call and this side is put. It is identical to NSC. Okay, at the moment it is trading around 39 rupees. Okay, sorry. Um this is the last traded price. So it is trading in, around 140 rupees. Okay, and this one is trading around. This is the last trading price. So this is trading about 170 rupees. Okay, so guys, please remember it is quite expensive to trade in this. Okay, now say for example, if you want to say buy puts at say 4500 levels or say 4700 levels. Okay, so it is 38 rupees, right? Roughly 38 rupees. So it will be 3800 rupees a lot. Right. Now, say for example, if you want to buy calls at say 5400 rupees. Okay. So it will be roughly 1500 rupees, this thing. Okay. So if you want, you can utilize this, but the only problem is there's no much of liquidity in this. So please remember that. You can see what is the open interest in this. 3, 21, 246, 163. Getting my point? On the put side, the open interest is 985. Okay. Everything put together, all the strike price of puts put together is 546 contracts. And all the calls put together, okay, if you look at here, is 741. So does this seem to be very matured?
No.
Okay. Let's see. Uh, Gold. Plus, it doesn't have consistency also. Okay. So please be mindful about this. So say in gold, everything put together is 1156 contracts. Everything put together is 1800 contracts. Is it very matured? Doesn't seem to be much, right? An open interest in a call and a put together in NSE for any stock would be a lot higher than this, correct? So there would be liquidity issues. Okay, so please remember that. Okay, make sense? And seventh is liquidity in options. Liquidity crunch in options. Okay, all of you. Okay. All right. Now you can do an intraday. Okay. You can also hold the position. There's no problem. Okay. Please ensure that when you're holding things, because day after tomorrow also we are going to discuss on this, because we'll first finish crude and then move on to gold and then silver and natural gas. But overall thing is that you can hold position, there is no problem. But generally what happens is that if you're keeping, say, a target of 100 rupees in a to be made out of crude oil in a month, okay, you will find that the day you are making positions, no, most likely the same day it will give you that return. Okay, so it has MIS orders also, and it also has cash and carry orders. So a mega contract, I guess, would be around how much? To carry would be around 60,000 rupees or so. Okay. Any questions?
So if we are carrying the position and there is a gap down against our position, how do we protect that?
For protecting it, you'll have to buy calls or puts.
But there is a liquidity issue, right?
Hmm.
Whatever we saw right now.
Hmm. There's a liquidity problem.
So we are carrying forward a position, we have to hedge with the collar of put.
What you can do is, in that case, say for example, um, say this is crude, say crude, okay, and crude now will be hmm, 17th of October, right? So anyways, the contract is rolling over, right? So you'll be trading in the October's contract, right? So now say for example, what is the previous month uh, futures low? How will you find it out? Okay, in the starting of the training today, did I tell you that when you are trading in say October contract, then this price is actually of October. Whatever is the price, it is treated to be the price of October, no matter you are trading it in September. Did I tell you this? So the current contract is of September, right? So the current contract is of September, so the price is of September. Okay. So what is the September low? Say on this contract, if we see, it started on 21st, right? It got active on 21st, right? So this is where the low is. Okay. So which is roughly 4600 levels, right? So in the next contract, if the price falls below 4600 levels, it will get bearish, right? And the same way, what is the high here? What is the high here? Roughly 5100 levels, correct?
Yeah.
Okay. Now, this is on the September's contract, right? So in the September's contract, we see that the high of September's contract is roughly say 5100 levels. Okay. And the low on the September's contract is roughly 4600 levels. Okay. Now, in the month of October, you will either have a bullish view or you will have a bearish view. Yes or no? So, if you are bullish, then you will expect that the price will go to 5200 levels, right? Or will close above 5200 levels on the October's contract. Now, let me also show you something. If I change this to say October 19th, okay, and add, what is the price currently over here? More or less same, right? This is October's contract and this is September's contract, right? Do you see more or less the price is same now? Because it is going to end today, right? Tonight, correct? Or tomorrow, whatever. The price is same because now it is getting closed and this September price is getting rolled over to October now. Yes or no? Okay. So for you, the levels roughly would be 5200 on the upside and say 4500 on the downside, correct? Now, if that is the case, let's look at this data of crude oil, 17th of October. So 4500 put is not even trading. Okay, 4700 put is 38 rupees. So this is 3800 roughly. Okay, and 5200 is roughly 100 rupees over here. Okay, so if you buy this, okay, and you want to short the market, all right, you can utilize this for the entire month, right? So you can utilize this for the entire month till the end of this expiry, which is on